Bitcoin is often called digital gold, but how does it actually work? At its simplest, Bitcoin is digital money that works without a central bank or single company controlling it. Its transaction history is stored on a public ledger that many computers maintain so anyone can verify activity independently. Bitcoin combines open software and cryptography, so rules are enforced automatically and transparently across the network. In 5 minutes, we will explore its creation in 2009, how the blockchain works, the 21 million limit, and how mining secures the system. The focus is clarity for beginners, so expect short animations, clear captions, and modern clean visuals throughout. Bitcoin first appeared in 2009 when an unknown person or group, using the name Satoshi Nakamoto, released the software and launched the network. The launch included a Genesis block that started the blockchain and referenced contemporary news to anchor its timestamp. Satoshi published a white paper describing a peer-to-peer electronic cash system that solved double spending without a central authority. Early adopters ran the software on home computers, and miners began competing to add blocks in exchange for newly created coins. That grassroots start grew slowly into a global network, maintained by volunteers, companies, and enthusiasts, all running the same open software. Understanding this origin helps explain Bitcoin's decentralized design and why no single entity can change the ledger alone. A blockchain is a chain of blocks where each block records a batch of transactions and links to the previous block. Each block contains a cryptographic fingerprint called a hash, which depends on its contents and links it to the prior block. If anyone tried to change an earlier block, the hash would change and break the chain unless every subsequent block was recomputed. This linked structure creates immutability because altering history requires enormous computational effort and consensus from the network. In short, the blockchain is a distributed tamper-resistant ledger that records Bitcoin transactions in chronological blocks. Bitcoin was coded with a fixed supply cap of 21 million coins to create digital scarcity, similar to precious metals. New coins are created as mining rewards, but the rate of issuance halves about every 4 years in events, called halvings. This predictable schedule means supply growth slows over time until all 21 million have been issued many decades from now. Bitcoin is divisible into 100 million units called satoshis, so you can own and use tiny fractions of a coin. Scarcity, divisibility, and open rules together create a digital asset, some describe as digital gold and others as programmable money. Remember, scarcity is built into the code, not controlled by any company or government, giving Bitcoin its predictable supply path. Mining is the competitive process where computers solve cryptographic puzzles to propose new blocks and earn a reward. The puzzle requires repeated hashing until a block hash meets a difficulty target set by the network to control issuance pace. When a miner finds a valid block, they broadcast it, and other nodes verify the proof of work and the included transactions. Multiple confirmations from subsequent blocks increase confidence that a transaction is final and cannot be easily reversed. The energy and computational cost of mining is what makes rewriting the chain expensive and helps secure the network. In short, miners secure transactions, enforce rules, and receive new coins, while the network collectively verifies the ledger continuously.